$620 billion. That is not a trading loss, not a credit default, not fraud. It is a math problem, a problem with a specific name, a specific formula, and a specific reason why so many institutions with billions of dollars in resources failed to calculate it correctly. That math problem is called duration, and its companion, convexity, is the correction that most people never apply. Together, they determine how much a bond loses when interest rates rise. In 2022 and 2023, not knowing them precisely enough brought down a $209 billion bank and nearly collapsed the British pension system. This is the story of those two numbers. Default is not the only risk in a bond. Timing matters. The mental model is price times time. Cash flows arriving under changing rates. Duration measures the timing sensitivity. Convexity measures the bend in the price-yield curve. Together, they turn a rate move into a balance sheet stress test. Before we talk about duration, we need to think clearly about what a bond actually is. A bond is not one payment. It is a scheduled series of cash flows, periodic coupon payments over the life of the bond, and then the return of principal at maturity. Imagine a 5-year bond with a face value of $1,000 and a coupon rate of 4%. Every year for 5 years, the bondholder receives $40. At the end of year 5, they also receive the $1,000 principal back. The question duration asks is deceptively simple. Given all these cash flows arriving at different points in time, what is the bond's effective time horizon? When, on average, does the money actually come back to you? The answer is not 5 years. The $40 coupons return in years 1, 2, 3, and 4. Each early payment pulls the effective time horizon closer to the present. And we weight each payment by present value because a dollar received in year 1 is worth more than a dollar received in year 5. The formal measure was introduced by economist Frederick Macaulay in 1938. Macaulay duration is the present value weighted average time until all cash flows are received. For each cash flow, multiply the time in years until receipt by the present value of that cash flow. Then divide by the bond's total price and sum across all payments. Macaulay duration is measured in years. To get a direct price sensitivity, we apply a simple adjustment. Divide Macaulay duration by 1 plus the yield. This is modified duration. Its interpretation is clean. If modified duration is about 4.4, then a 1% rise in yields reduces the bond's price by roughly 4.4%. Duration works well when interest rates move in small, orderly steps. But markets do not always cooperate. When rates move by 100, 200, or 400 basis points, duration gives you a dangerously incomplete answer. The reason is geometric. The true relationship between a bond's price and its yield is not a straight line. It is a curve, specifically a convex curve that bows outward toward the bondholder. Duration treats this curve as if it were linear, taking the slope at one point and extending it. For small moves, that approximation is fine. For large moves, the true price lands somewhere meaningfully different from where the linear estimate points. The cure for duration's linear limitation is adding a second-order correction term, convexity. This comes from the Taylor series expansion of the bond pricing function. The first term gives the linear estimate from duration. The second term adds a quadratic correction for curvature. Together, duration plus convexity can reduce the estimation error from several percentage points to a fraction of a percent, even for very large rate moves. Most plain government bonds have positive convexity, but mortgage-backed securities can have negative convexity. Homeowners can prepay mortgages when rates fall, removing part of the upside that normally comes with a bond's convexity. When rates rise, they do not prepay, so losses can accumulate faster. The curve bows inward rather than outward. That is why credit quality alone is not enough. Silicon Valley Bank was not reckless by conventional measures. It did not make sub-basis point prime loans. It did not speculate in derivatives. Its bond portfolio consisted mostly of U.S. Treasury securities and agency mortgage-backed securities, low credit risk instruments, but not all identical in interest rate behavior. The credit risk was low. The fatal exposure was duration, funded by deposits that could leave immediately. Between 2019 and 2022, SVB's deposit base more than doubled from $62 billion to $124 billion. Management invested much of this inflow in long-duration bonds. By December 31, 2022, SVB held $91.3 billion in a held-to-maturity bond portfolio with a weighted average duration of roughly 6 years. Against this, demand deposits repayable immediately, duration approximately zero. The Federal Reserve raised its policy rate from 0.25% in March 2022 to 4.5% by December 2022, 425 basis points in 9 months. One of the most aggressive tightening cycles in modern Fed history. With a modified duration of approximately 6 years on the held-to-maturity portfolio, a 425 basis point rise implies a mark-to-market loss of about -6 times 4.25%, or roughly -25.5%. Applied to $91.3 billion, that is approximately $23 billion of estimated loss. SVB's own filing showed $15.2 billion in held-to-maturity unrealized losses. Whether you use the simplified formula or the actual filing, the number dwarfs SVB's equity base of approximately $11.8 billion. Here is a crucial nuance. SVB was not required to report those losses on its income statement in real time. Under U.S. accounting rules, assets classified as held to maturity are carried at amortized cost. The market losses appeared only as footnotes. They did not flow through regulatory capital ratios. This is not fraud. It is accounting convention, built on the logic that if you hold a bond to maturity, you eventually receive par value regardless of intermediate price fluctuations. The logic is sound unless a bank run forces you to sell before maturity, which is exactly what happened when SVB sold $21 billion in available-for-sale bonds to meet withdrawals. Across the Atlantic, a different type of institution was dealing with the same concept of duration from the opposite angle. British defined benefit pension funds have a fundamental duration problem. Their liabilities, the future pension payments they owe retirees, are extremely long-dated. Many UK pension funds adopted liability-driven investment, or LDI, to match asset duration to liability duration. The theory is sound. If interest rates rise, the present value of future pension obligations falls. If the assets fall by the same amount, the funding ratio stays stable. But for many schemes, the implementation used significant leverage. Leverage plus immediate collateral requirements turned a conservative hedge into a fragility machine. On September 23, 2022, the UK Chancellor announced the mini-budget, an unfunded package of tax cuts. Markets read the announcement as a threat to fiscal credibility. UK gilt yields rose by more than 100 basis points in 4 days. For a 20-year gilt, a 100 basis point yield rise implies a price drop of roughly 15 to 18%. LDI funds that had posted gilts as collateral saw that collateral value fall below the required level. Margin calls arrived. To meet them, funds sold gilts. Those sales pushed yields higher, which triggered more margin calls, which forced more sales. The Bank of England later found that LDI selling accounted for roughly half of the decline in gilt prices during those 4 days. The loop ran until the Bank of England stepped in with emergency gilt purchases. Before drawing lessons, 4 things deserve honest statement. First, duration is a local approximation. It is strongest for small parallel yield curve shifts. Second, curve shape matters. Real curves steepen, flatten, and twist. Third, cash flows are not always fixed. Callable bonds and mortgage-backed securities can change the timing of payments. Fourth, accounting is not cash. A model can be useful and still fail if liquidity arrives before maturity. The takeaways are simple. Duration is timing, the present value weighted average of when the money comes back. Modified duration is sensitivity, the first-order estimate of how a rate move becomes a price move. Convexity is bend, the correction that controls tangent line error. Accounting category is not cash. A held-to-maturity label does not remove liquidity exposure, and hedges need funding. A mathematically sound hedge can still fail when collateral calls arrive faster than cash. In 1938, Frederick Macaulay introduced a measure for the present value weighted average of a bond's cash flows. He called it duration. It was a tool designed to help investors think precisely about when their money would come back. 84 years later, a bank with $209 billion in assets and a pension system protecting millions of British retirees, both discovered that they had not thought carefully enough about exactly that question. Duration and convexity are not warnings about exotic risk. They are the basic arithmetic of owning a bond. The question worth sitting with is not whether institutions understood the concepts in theory. They did. The question is why so many failed to model their actual exposure under the conditions that arrived. This video is for educational purposes only. It is not investment, legal, tax, or risk advice. The numbers are simplified for explanation and sourced from public filings, institutional research, and standard fixed income mathematics. Actual bond prices depend on embedded options, credit risk, liquidity, and non-parallel yield curve shifts. Always check the original sources and consult a qualified professional before making financial decisions.